Silver is no longer sitting quietly in the $30 range waiting for permission to move. Because right now, at this very moment, institutional analysts, commodity strategists, and veteran precious metals traders are circulating internal projections showing silver potentially rocketing toward the $300 zone over the coming cycle, representing a staggering 280% upside from current levels. And if you are a retiree watching your savings get obliterated by inflation, if you are a safe haven investor who understands that the financial system is cracking under unsustainable debt, or if you are a silver stacker who has been waiting years for this metal to finally break free from manipulation and suppression, what is unfolding right now in the silver market is not a rumor, not a fantasy, not a pump scheme. This is a legitimate supply-demand crisis colliding with monetary chaos, geopolitical instability, and a Federal Reserve that is completely trapped between runaway inflation and a debt bomb that cannot be defused without destroying the currency. And the smart money is not waiting for mainstream media to announce this move. They are positioning aggressively right now, while silver is still trading at levels that will look absurdly cheap once this breakout accelerates, and the broader public finally wakes up to what is happening. The fundamental case for silver exploding toward $300 per ounce is not built on speculation or hopium. It is built on brutal math, supply deficits that are widening every single quarter, industrial demand that is surging because of electrification, solar panel production, 5G infrastructure, electric vehicle manufacturing, and military applications that require silver's unique conductive properties. And meanwhile, mine production is stagnating. Recycling cannot keep pace. Above-ground inventories are draining at alarming rates, and the physical market is so tight that premiums are spiking. Delivery delays are stretching longer, and refiners are struggling to source enough material to meet orders. And this is happening while investment demand is still relatively quiet compared to where it will be once the next wave of inflation panic, currency crisis, or financial system stress sends millions of investors scrambling for hard assets that cannot be printed, debased or inflated away by central banks that have lost all credibility and discipline. Inflation is not transitory, it is not under control, it is not going away. And retirees are being hammered harder than any other demographic because they are living on fixed incomes. They are drawing from savings that are losing purchasing power every single month. They are watching grocery bills explode, energy costs surge, healthcare expenses skyrocket, insurance premiums climb, and property taxes increase, and the dollars they saved over decades of hard work are buying less and less with every passing week. And the Federal Reserve is offering no real solution because they cannot raise interest rates high enough to truly crush inflation without triggering a debt crisis, a recession, or a complete collapse in asset prices that would destroy pension funds, retirement accounts, and the entire financial system that is built on a foundation of ever-expanding credit and ever-increasing debt that can never be repaid at current values. The Fed is trapped in a nightmare scenario where they must choose between letting inflation run wild and destroy the currency, or raising rates aggressively and triggering a deflationary collapse. And either path leads to the same destination, which is a loss of confidence in fiat money, a flight to hard assets, and a massive revaluation of precious metals that have been artificially suppressed for decades through paper market manipulation, futures contract games, and central bank interventions that are now losing effectiveness because the physical market is completely disconnected from the paper price. And when that disconnect becomes undeniable and the price discovery mechanism shifts from the COMEX to the physical market, where real metal changes hands, silver is going to gap up violently to levels that reflect true scarcity, true demand, and true value in a world where trust in governments, central banks, and fiat currencies is evaporating rapidly. The dollar is losing its grip as the world's reserve currency, not overnight, not in a single dramatic collapse, but in a slow, grinding erosion of confidence as foreign central banks diversify reserves, as BRICS nations push for alternative trade settlements, as geopolitical tensions fracture the post-World War II monetary order, and as the United States continues to weaponize the dollar through sanctions, freezes, and financial warfare that is teaching the rest of the world that holding dollars is a political risk, not just an economic decision. And this gradual loss of reserve currency status means that the structural demand for dollars is declining, which means the Federal Reserve's ability to export inflation by printing money and having the rest of the world absorb it is diminishing, which means inflation is going to hit the domestic U.S. economy harder than at any time since the 1970s. And when that happens, when retirees and middle-class savers truly feel the pain of currency debasement eating their wealth, the rush into silver and gold is going to be unlike anything we have seen in modern history. Silver stackers who have been accumulating physical metal for years, who have endured mockery, who have watched paper markets suppress prices, who have stayed disciplined through endless consolidation and manipulation, are about to be vindicated in a way that is going to shock the financial world because the setup right now is absolutely historic, with supply deficits projected to persist for years, with industrial demand growing exponentially because of the green energy transition that requires massive amounts of silver for solar panels and electrical components, with investment demand poised to explode once inflation fears intensify, and once the broader public realizes that traditional savings vehicles like bonds, cash, and money market funds are wealth destruction machines in an inflationary environment, and with central banks around the world trapped in policies that require continuous money printing, continuous debt monetization, and continuous currency debasement just to keep the system functioning, which means the nominal price of hard assets like silver must rise dramatically just to reflect the loss of purchasing power in the underlying fiat currencies. The $300 target is not a wild guess. It is based on historical ratios, inflation-adjusted highs, supply-demand modeling, and monetary debasement trends that are already locked in and accelerating. Because if you adjust silver's 1980 high of $50 per ounce for official inflation using government CPI data, you get a number well above $150. And if you use real inflation measures that include housing, energy, and food at true market weights, you get a number closer to $300 or higher, and this is before accounting for the supply deficit, before accounting for the surge in industrial demand, before accounting for the investment demand wave that has not even started yet, and before accounting for the leverage effect where silver historically outperforms gold by multiples during precious metals, bull markets because of its smaller market size, its dual role as both industrial commodity and monetary metal, and its volatility that attracts speculative capital once momentum builds. Retirees cannot afford to ignore this setup because they are the most vulnerable to inflation, they have the least ability to recover from wealth destruction, they are living on assets accumulated over lifetimes of work, and those assets are being silently confiscated through monetary debasement that is intentional, that is policy. That is the only way governments can manage unpayable debts without outright default. And the choice is binary. Either you protect your purchasing power by moving a portion of your wealth into hard assets that cannot be inflated away, or you watch your savings erode year after year until your standard of living collapses and your financial security evaporates. And this is not fear-mongering. This is the documented historical pattern of every fiat currency system that has ever existed, and the US dollar system is now 50 plus years into the pure fiat experiment that began in 1971 when Nixon closed the gold window, and the endgame of that experiment is playing out right now in real time with inflation, debt, deficits, and currency instability that cannot be solved within the current monetary framework. The silver market is tiny compared to global financial markets, with total above-ground investment-grade silver inventories representing a fraction of the wealth held in stocks, bonds, real estate, or even cryptocurrencies. And this means that even a small shift in capital allocation, even a modest increase in investment demand, even a minor loss of confidence in fiat currencies can send silver prices parabolic because there simply is not enough physical metal available to satisfy a surge in demand. And we are already seeing early warning signs of this dynamic with premiums rising, with mints struggling to keep popular products in stock, with delivery times extending, and with the spread between paper prices and physical prices widening, which is exactly what happens in the early stages of a supply crunch, when the market is transitioning from a paper-driven pricing mechanism to a physical-driven pricing mechanism where actual metal scarcity determines value. Smart money is positioning now, not later, not after the breakout is confirmed, not after silver is trading at $100 or $200 and the move is front-page news. They are accumulating right now while prices are still relatively suppressed, while the broader public is still distracted by stocks, crypto, and other speculative assets. While sentiment is still tepid, and while physical metal is still available at reasonable premiums, because they understand that once this move accelerates, once the momentum builds, once the public catches on, the opportunity to accumulate at affordable levels will vanish, premiums will explode, availability will disappear, and the only option will be to chase prices higher or sit on the sidelines watching in regret as one of the greatest wealth transfers in modern financial history unfolds. The geopolitical backdrop is adding rocket fuel to this setup because tensions between major powers are escalating, because trust in international institutions is collapsing, because the global financial system is fragmenting into competing blocks, and because nations are increasingly viewing gold and silver reserves as strategic assets that provide independence from dollar-dominated payment systems, and this is driving central bank buying of gold to record levels. And while central banks do not typically buy silver in large quantities, the signal they are sending about the value of monetary metals is pushing private investors, sovereign wealth funds, and institutional players to diversify into physical assets, and silver benefits from this trend because it offers the same inflation protection and monetary hedge as gold, but at a much lower entry price and with much higher upside potential because of the supply-demand fundamentals that are dramatically more bullish for silver than for gold. The debt situation in the United States is completely unsustainable, with federal debt exceeding $36 trillion, with annual deficits running over $2 trillion, with interest payments on the debt now consuming more of the federal budget than defense spending, and with no political will or mathematical possibility of reducing deficits without either slashing entitlement programs that are politically untouchable or raising taxes to levels that would crush economic growth, which means the only path forward is continued debt monetization, continued money printing, continued currency debasement, and continued inflation that is baked into the system regardless of what the Federal Reserve says or does. And this is the environment where silver thrives, where hard assets outperform, where purchasing power protection becomes the primary investment objective, and where retirees who fail to position defensively will see their wealth systematically destroyed by policies designed to inflate away government debt at the expense of savers and fixed income recipients. The industrial demand story for silver is being dramatically underestimated by mainstream analysts who focus on investment demand and ignore the fact that silver is an irreplaceable input in technologies that are experiencing explosive growth, including solar energy, where each panel requires approximately 20 grams of silver, electric vehicles, where each car uses between 25 and 50 grams of silver in electrical systems, 5G infrastructure, where silver's conductivity is essential for high-frequency signal transmission, and military applications where silver is used in missile systems, radar, and electronic warfare equipment. And this industrial demand is not discretionary. It is not price-sensitive. It is structural and growing, and it is consuming an ever larger share of annual silver production, which means less metal is available for investment demand, which means any surge in investor buying will hit a market that is already in deficit and will drive prices exponentially higher because supply cannot respond quickly, because mine production takes years to ramp up, and because recycling cannot fill the gap when investment demand and industrial demand are both surging simultaneously. The psychological shift that is coming in the next phase of this crisis is going to be profound, because right now most investors still have faith in the system. They still believe central banks can manage inflation. They still trust that government policies will protect their wealth. They still assume that traditional asset allocation models will work, but that faith is going to be tested and broken as inflation persists, as currency instability increases, as geopolitical risks escalate, and as the gap between official narratives and lived economic reality becomes undeniable. And when that psychological shift occurs, when the public loses confidence in fiat money and traditional financial assets, the stampede into precious metals is going to be chaotic, aggressive, and unstoppable. And silver will be the primary beneficiary because it is more accessible than gold, because it offers higher percentage gains, and because the physical market is smaller and tighter, which means price moves will be more violent and more dramatic. Retirees who are living through this crisis in real time are already feeling the pain of inflation destroying their purchasing power. They are already cutting back on expenses. They are already watching their savings shrink in real terms. They are already worrying about whether their money will last. And they are the ones who need to act most urgently because they have the least time to recover, the least ability to earn additional income, and the most to lose if they continue holding assets that are being debased by monetary policy. And the solution is not complex. It is not risky. It is not speculative. It is simply recognizing that a portion of retirement savings must be allocated to hard assets that maintain purchasing power over time. And silver represents one of the most compelling opportunities in that category because of the unique combination of supply deficits, industrial demand growth, monetary debasement, and geopolitical instability that are all converging at this exact moment in history. The 280% upside to $300 per ounce is not a guarantee, it is not a promise. It is a mathematically derived projection based on supply-demand fundamentals, inflation-adjusted historical prices, and monetary debasement trends, and it represents a realistic scenario if the conditions that are already in place continue to develop, if the supply deficit persists, if industrial demand keeps growing, if investment demand accelerates, and if the dollar continues to lose purchasing power. And all of those factors are not speculative, they are observable, they are measurable, and they are trending in the direction that supports significantly higher silver prices over the next several years. And investors who position early, who accumulate physical metal while it is still available, who think independently rather than following the crowd, are going to be positioned to benefit enormously from a move that most people will miss because they waited too long, because they dismissed the fundamentals, or because they were too anchored to traditional financial assets that are going to underperform dramatically in the inflationary environment that is unfolding. The Federal Reserve's policy options are exhausted. They have no good choices left. They cannot raise rates without crashing the economy. They cannot lower rates without fueling inflation. They cannot continue printing without destroying the currency. And they cannot stop printing without triggering a deflationary collapse. And this impossible situation is exactly why precious metals are breaking out, why institutional money is quietly repositioning, why sovereign buyers are accumulating, and why anyone paying attention to monetary policy, debt dynamics, and currency trends is moving capital into hard assets that cannot be manipulated, debased, or printed into existence by central banks that have lost control of the inflation monster they created. The window to accumulate silver at current prices is closing rapidly, not because of hype, not because of manipulation, but because the physical market is tightening, because supply is constrained, because demand is accelerating, and because the gap between paper prices and physical reality is widening to a point where it will soon become unsustainable, and will resolve violently to the upside when the market reprices silver based on actual availability rather than futures contract games played by banks and speculators who have no intention of taking delivery. And when that repricing occurs, when the physical market asserts control over price discovery, the move is going to be explosive, fast, and unforgiving to those who waited too long to position, and retirees, stackers, and safe haven investors who understand this dynamic are acting now, are securing physical metal now, are protecting their purchasing power now, because they recognize that the time for hesitation has passed, and the time for decisive action is right now while metal is still available and while prices have not yet reflected the full magnitude of the supply-demand crisis that is accelerating every single day. Financial disclaimer: the content presented in this script is for informational and educational purposes only and does not constitute financial advice, investment advice, trading advice, or any other form of professional advice. The projections, price targets, and market analysis discussed are based on publicly available information, historical data, and market trends, but all investments carry risk, including the risk of loss of principal. Past performance is not indicative of future results. Silver and precious metals markets are volatile and can experience significant price fluctuations. Viewers are strongly encouraged to conduct their own research, consult with licensed financial advisors, and carefully consider their individual financial situation, risk tolerance, and investment objectives before making any investment decisions. The author and publisher of this content make no representations or warranties regarding the accuracy, completeness, or suitability of the information provided, and disclaim any liability for financial losses or damages resulting from reliance on this content.